See if we get anybody out there. It says we're live, but you never know how the first few minutes of going live are ever going to go. It says there are 10 people joining us already, so fantastic.
Wow,
Well,
right out the
yeah,
gate.
10 whole people. Hopefully they're real people and not bots. If they are people, let's see some likes out there. Click the like button. Nolan, thanks for joining. I don't know if we want to start off with anything right out of the gates. I wanted you on here because holy moly, is the mortgage world upside down, and I don't know what to make of it, man.
That makes two of us. I don't know if I'm going to be able to help at all.
So, I mean, I guess really what I probably want to start covering first, more than anything, I guess the question on everybody's mind right now for a mortgage broker is, what are you seeing? Are you getting those emergency calls right now for people that are panicking, or are we still too early? Because right now, I guess we're still in 2019 rate renewals.
Yeah, totally. I mean, we haven't hit that point yet where we're seeing those early 2020 renewals coming up yet. The panic calls we're getting right now are the people who have been shopping for a home for like 4 to 6 months and didn't have a rate hold in place. Didn't think about going and getting a pre-approval, or got told, "Hey, by their banker, yeah, you're good. Go ahead. No problem. Go buy a place." And then it took them 3 months to find a house, and they didn't realize that interest rates had gone up, and all of a sudden now they don't qualify for what they qualified for 3 months ago. So those are the kind of the emergency ones. We're able to help some, not able to help others. Some people should have never been told to go look for a house in the first place, but
Yeah.
that's kind of the crisis we're seeing at the moment. And then there's a series of other ones that are bound to come up in the next little while.
Well, hopefully in the next couple of minutes here, we can get some crisis questions as people start joining in. These are supposed to be AMAs, right? I'm supposed to try and get people to actually type in some sort of questions in the comments. But for the first usually 5 or 10 minutes, people get pretty shy. And then one person puts in a comment, and then everything else goes easy after that. But
I gotcha.
I am experiencing the same thing as you are, where like I see the shift in our market right now because in, let's call it June, you could still secure like I don't know, even some 4.89s, but let's call it 5.39 type rates. Maybe credit unions here, lots of credit unions were being used. Maybe not so much where you are in Alberta, I'm not sure. But now when those bond yields went crazy, it appears like now everybody's like 6.09 or higher at this point. And that, as you and I always go by that kind of that 1%, 10% rule, that puts you in about a 15% downward pressure on price. Doesn't make
Yep,
anything more
exactly.
affordable, but it does
No,
put pressure down. So I'm just interested, we are now having people that have completely walked away from the market because they did sleep on those rates and everybody right now would take a 5.39 no matter what.
oh yeah, without a doubt.
So
Yeah, I think that's not uncommon though. When you have interest rates that go up and you have all sorts of uncertainty, people do take a break, and somewhat to be expected.
but how long, I guess, until those make sense again? Because you do need to see about a 14, 15% decrease in purchase price to now make sense of the exact same payment you would have had for the same house.
Yeah, no, totally. There's no question about that. The affordability is constantly changing right now. Every single time interest rates move, the affordability moves, and the math that each individual needs to do in order to see if they can afford it changes. But I mean, there's still the lifestyle changes too, right? There's still the people who just got coupled up and don't want to live in the one bedroom bachelor pad anymore. There's the people who have the baby on the way. There's the people who realize that, the new job with the 90-minute commute really sucks. There's all the lifestyle changes that are going to continue to be transactions. The question now becomes, how much speculative real estate is there that could potentially come to the market? This is a really interesting topic, especially in BC. There's the pause with respect to interest rates, and really, like, when it comes to that 15% headwind, when we get a real estate market that kind of hits the top or hits a moment of thought, let's call it, there only needs to be a few buyers to continue to support the values. And as long as there's a few buyers that are continually willing to buy at those values, then everything's pretty much okay. It's when those buyers completely disappear and everyone gets scared. Like that's what happened in 2008. There was this pause at the top of the market. Everyone was kind of like waiting to see what happened. And then Lehman Brothers collapsed, and all of a sudden there was no one available to support the prices, and the prices dropped. It takes a big adjustment, though. It takes a big piece of news in order to get all the buyers to disappear. And the question is, are we finding ourselves in a situation where that's going to happen in the near future in Canada? And that's anybody's guess, right? But the question is like, what's the next big news piece? Because the higher interest rates have kind of shown that it doesn't stop the buyers that still need to buy.
It doesn't stop too when you're adding to the amount of buyers that are coming, right? Like although I get the feeling right now that people are laying off. But if you would have told me a year and a half ago that rates are going to be where they're at, I would have said we were in utter collapse. I would have said we were 50% price drop.
Yeah.
I would have thought that's where we are.
You tend to go that direction though, right? That's your
true.
set point, right?
That is true.
Other people have different set points, right? So, I mean, that's cool. It's when you have these conversations, like this is for anybody who watches on YouTube, this is what you need to do. You need to go and figure out all the set points for the YouTubers that you're watching. So like that one guy, that's an absolute lunatic. He's got a set point, and then you've got a little bit more reasonable set point, and then I might have a set point, and then some other realtor in Toronto might be like, no, everything's fine. It's always going to be good. And that's their set point. And, the question becomes, what's your set point as an individual if you're watching all these people? And then who do you believe, and how do you take all of their information and digest it, right?
Yeah. Yeah. We actually have one actual real question. It's your first one, Nolan. And this is actually for you. For what you're seeing out there right now, the question is prime -1 a decent offer in today's market?
I mean, from a discount to a variable rate perspective, yeah, it's pretty good, pretty reasonable, kind of what you would expect to see. Is it the best mortgage option though? There's a lot more variables to that variable question. The other thing you got to remember is like, I've become very cautious of answering any questions about variable rates because I talked for like the last 4 or 5 years about how you didn't want a fixed payment variable rate. And then everyone went and got a mortgage at TD Canada Trust. And then I had 2 years worth of comments on my YouTube channel talking about how I was awful because I told people to get variable rates. I'm like, yeah, but I didn't tell you to get that one. And I'm not 100% sure it's my fault that you missed the entire part of the story.
Yeah. And so it's funny that you say that because I actually, I've had TD mortgages in the past. I've never had that product, but I do have a broker that I use most often, and he goes much down the same lines as you do. He's very much in the same train of thought for the most part. And I want to say about 9 months ago, maybe more, maybe even a year ago, there was a bunch of guys that would get approved, say with the broker, and then between subject removal and closing, they walked into particularly a TD branch, and that was the one product that hooked them, and they thought they were getting such a smoking deal. And I actually remember one client in particular. I was like, listen, not only is it a pain in the butt, I believe in your book you call it a Richard, right? You've already wasted the broker's time to do that, but now you're taking on a product that is potentially going to really hurt you. And their only thing at the time, well, it was 0.05% cheaper. And they are not in good shape now as a result of it. And then you give the advice, and what can people do, right? They just think a variable is a variable and a fixed is a fixed. And I mean, I guess when you're talking about like people's different kind of mindsets and where they are, I've always been that fixed rate mindset guy. And the funny part about that is the mortgage that I have that was variable is probably the best thing I've ever done. So what does that tell you? I probably should go that way. But right now, if I was looking at things right now, personally, I might be, if I'm renewing in the next 6 months, I might be looking very hard at a variable rate. I might be.
Yeah. So just kind of back up on this, and then we'll get to whether, variable versus fixed and what you should be looking at right now. Uh, you know, just going back to that rate question, is prime minus one a decent offer in the current market? I'm going to go back to the three P's: product, penalty, price. Before you ask me if prime minus one is a decent offer, there's a whole bunch of things with the product and the penalty that come into play on that before we can even take a look at the interest rate. So you're putting the interest rate first, which is wrong. That's the thing that you shouldn't be putting first. What you should be looking at is the product. A lot of that has to do with who the lender is and the penalties and all of the things associated with the fine print in the contract, and then determine, okay, from there, now that what we know what the product is the price right? And then if we're getting into a conversation about fixed versus variable, this is one of those conversations right now where everyone's like, oh, okay, well, now it's time for a variable because rates have gone up and they have to go down. And the Bank of Canada is saying that rates are going to go down in 2024. The Federal Reserve is saying that the Bank of Canada or the rates are going to go down in 2024. And yet, a year ago and 2 years ago, they were saying we were going to see rates really low into the end of 2023. And that's not where we're at.
Yeah.
So, I don't think basing our decisions on forecasting is the way to do it, because anytime you try to do that, you get it wrong. I think you have to go back to the basics and having a system. And I'm still a big believer in you take the mortgage that's the cheapest at the time. And as of right now, fixed rate mortgages are still cheaper than variables. So this is going to be the one time where I tell people to
5-year fix though is what's cheaper right now, because 3 years aren't that discounted, are they?
No, and the shorter term mortgages are higher priced, right? So do I take a 3-year mortgage or do I take a 5-year mortgage if they're 0.5% apart? Well, if I'm smart, what I do is I know that the question is not the rate, it's the product. And if I know that I have a low penalty product on a 5-year fixed, I take the 5-year fixed, I get the lower interest rate. And if interest rates go down in 2 or 3 years, I have a low penalty with the right lender that's not a big bank, and I can refinance to a lower rate if rates go down. But at the end of the day, like, I have to be clear, I'm not telling anybody to take a fixed or a variable. I'm saying that there's so many more components to it than just the rate and the type of mortgage. And if people would have listened to that part of the advice 2 or 3 years ago, we probably wouldn't find ourselves in a situation where we're going to find ourselves in the next 3 to 5 years with mortgages coming up for renewal.
Totally. So I noticed old Tommy has just joined us in the comments here, and this is going to be front of his mind right now because he's doing a renewal. Here's us. Maybe I want to ask you this particular question. So I have a few people, a couple that are close to me, not just professionally, but in around my life right now, that are doing their renewals now. And my advice to them has been, right now, pay attention to how easily you can port a mortgage in the event that you want to, I don't know, flee the city and go to Calgary or Vancouver Island or wherever people want to go these days. Or if things do get better, the lowest possible penalty. So let me give you an example. Let's say, for instance, somebody does lock into a 5-year fixed rate right now, and they're, I don't know, what is that? Let's say 6.19, 6.29%, something like that. And rates do drop 3/4 or a point by this time next year, and they want to revisit something, and they maybe want to look at changing, not lender, but maybe getting a new rate or whatnot. What lender right now might, and don't say one, but maybe give me 2 or 3, what is the right lender that would have a product? Because everybody just thinks TD, RBC, Scotia, and they don't think about those other ones. So what are some company names where they might actually be able to facilitate somebody that wants to move on later, even if they lock into a 5-year now?
Well, the easier to answer question, is actually the who won't let you do it. And that's any big bank. So you take any of the big 6 banks in Canada and you get a mortgage there and you take a 5-year fix right now, you're in for 5 years, period. Unless you sell the house and pay the penalty. And if you have a penalty and rates did go down, you're paying a pretty substantial penalty. Like, there's a reason why the broker lenders, and brokers can deal with TD. They can deal with Scotiabank. BMO is coming back into the broker channel because BMO realized when they left the broker channel, I don't know, 10 years ago or whenever it was, that their market share on mortgages, they went from like number 2 or 3 to basically last because they lost that broker share. So we're seeing banks come back into the broker channel. But the other lenders that the brokers use, the First Nationals, the MCAPs, the CMLSs, the Equitable Trusts, all of those lenders are lenders that are essentially funded by the big 6 banks, but they have products that are better because they have to. Otherwise, they wouldn't be able to compete. So, taking a mortgage, basically getting a mortgage and saying, with a mortgage broker and saying, I want to be set up so if rates go down, I can make a change, is the path forward. And then just make sure the broker that you're dealing with knows how to set that up.
So let's say, for instance, you are looking at, I don't know, who's going to give you the best rate right now. Maybe RBC is going to give you the best rate on a 5-year from what you're finding, or they're very comparable to, I talked to Nolan or an independent broker, and they take me to like, I don't know, a First National or an MCAP or somebody. What is like the approximate, and obviously every mortgage is different. I'm not going to hold you to a particular number, but like, is there a rate, a percentage, an idea of what the difference between those penalties is? Because I think we're going to end up in a spot where people think they're going to renegotiate at a big bank. They're going to, if rates do come down 1.5%, 2%, they're going to go back to the bank, and the bank's going to be like, cool, here's your $45,000 penalty.
Yep. And then what the bank's going to do is going to say, don't worry, we'll take care of you. We'll do what's called a blend and extend. And what they're doing is they're just making the contract longer. They're averaging down the rate that you're actually paying right now. And they're just giving you an extension to make it the rate appear to be lower, but you're still paying the same cost. You're just locking in for a little bit longer. And what we're talking about here is we're talking about actually being able to have savings by paying out the penalty. And that's the important distinction. And I have no idea what the question you asked me was, but that was really important. An important distinction was like, it's knowing that you're actually going to be able to switch and get a better product and a better rate.
So, for instance, though, if what would be the difference in a penalty, like in dollar amounts? Like, would it be like, okay, if this bank over here is 25 grand, this bank over here is 1, 2, 3, 4, 5,000? Like, what is the difference?
Yeah. So historically, when interest rates are going down and an interest rate differential gets implemented, historically over the last 15 years, it's been about 3 to 5 times the penalty with the big bank that it would be with a monoline lender. So you could have like a Merrick's financial mortgage that's funded by RBC. You never know who the funder is behind it, but let's just say it was funded by RBC. And the penalty at Merrick's might be $3,000, and at RBC, it could be $15,000. And the difference between those penalties is about the equivalent of what you could save if you had the Merrick's mortgage, paid the penalty, and got a lower rate elsewhere.
Yeah, I think so many people are going to get caught. So many people are going to get caught because they're still going to just go with whatever the lowest rate is, the lowest payment. Because I think that's the key right now to the renewals that are coming. Everybody's going to get tricked with whatever they can do to get the lowest payment possible. And my personal thought is everyone being 75% of people, are going to be pushing out their amortizations as long as they possibly can. I think that's going to be the next move that you're going to see. Now, I would assume, though, whenever someone comes to you and switches lenders, they probably push out the AM anyway.
No. So when you do a switch like that, you actually have to keep the existing mortgage to get the basically all the terms in order to get the new lender to be able to pay for the change. And then if you had mortgage insurance at some point, the mortgage insurance makes the mortgage significantly cheaper. You pay for it up front. It's not like the US where you pay for it on a monthly basis. So there's no point in getting rid of it. In fact, you want to do everything you can to keep it if you have it. So you want to keep that existing mortgage, and then you're just switching to another lender for a lower rate.
And do you feel like people are going to be in a position where they can switch with the stress test being where it is? Because right now, I think it's probably criminal that if OSFI's not going to allow people to change lenders without a stress test, like I think they should go, no matter what, you can change lenders.
Yeah.
As long
they just clarified
as
that actually.
You keep the exact same loan.
Yeah, they just clarified that actually. They did. They are saying that if you're switching to a different lender at renewal, you don't have to apply the stress test. Now, that being said, the question becomes if you're a lender and you've got a client who has a property whose values come down or whose payments are way out of line, are you going to want to take that mortgage unstress tested because it becomes a higher risk mortgage for you than a brand new one coming off the street? But OSFI has clarified and said, being OSFI being the Office of the Superintendent of Financial Institutions, they're the bank regulator, and they've said, yeah, you can switch to a different lender at renewal without being re-stress tested. But your amortization, everything else has to stay the same.
There's some other stuff here. What's here's the forever question. What is saving us from the collapse? Nolan, what is saving us right now? Technology, or is it something more nefarious?
Well, okay, I think 2008 creates this reasoning for people that when housing prices go up, they have to crash, right? And so, oh, housing prices went up, things are getting more expensive, life's getting hard, crash is imminent. It's like, that's not exactly how it works. For a crash to really happen, there has to be something catastrophic change. And right now, like, people are still paying their 5-year fixed mortgage payments. People are still paying their variable rate mortgage payments that have fixed payments. Oh, and people who have adjustable rate mortgages where the payments have changed, by the way, are also still paying them. So there's really no change in the ability to pay as of right now. Now, how could that change? Okay, let's say unemployment starts to tick up, and it will. The question is, how bad does unemployment get? And then what percentage of people can't make their payments? And then if it gets really, really bad, could you see something happen? Yeah, but you have to keep in mind that like 2008 was a complete financial meltdown globally. And that's not where we're at right now. Where we're at right now is everything's getting more expensive, but people are still employed. And there could be a recession and there could be some pain for a small percentage of people. But without there being some catastrophic event, there is no crash.
I don't see exactly where that's coming. Like, obviously, I guess that would be the thing. Nobody sees it coming, right? But to me, there's not a lot of, unless I'm completely ignorant to it, there's not a lot of bad loans out there. And that's what they did in the States. I mean, my best friend in the whole world is a realtor in Seattle. And I remember going at a young age to parties, and they were guys that were just buying properties 120% finance with no incomes. You know, it's, they say they want 300 for it. I took a loan for 360 and I built a shop out the back and bought a truck with what was left over. And yeah, can you pay for that? Yeah, we're not going to worry about that. And then they had their 2-year, I don't know if it's exactly the same or not, but a lot of them went on like 2-year AMs at that time. I don't know if they didn't have a 30-year AM at that point. I don't know how the U.S. works. I guess that's one thing that could be brought in here is longer amortizations, but the rates are just so out of line that nobody's interested in them.
Yeah, well, interestingly enough, Equitable Bank last week announced that they were reintroducing 40-year amortizations. Now, ironically, the way they announced it is that they're doing it through a third-party lender, so it's not their lending product. Therefore, it falls outside of the OSFI guidelines that they have to follow, but they're being the originator and the servicer of those mortgages. So 40-year amortizations are actually something that's going to come back. This is something that I thought, even going back to like 2012, 2013, when they started eliminating the longer amortizations, I thought that might be a way that they can eliminate some stress down the road, but people are going to have to change their mortgages to get that. The 2-year amortizations in the States, those weren't 2-year amortizations. They were 2-year adjustable mortgages, probably on 15 or 30-year amortizations, more than likely on 30-year amortizations. But the 2-year adjustability was something that was uncommon in the States. And when all those mortgages reset in 2007, that's what created a large part of the issue really quickly. The bigger issue was the fact that their lending practices were, can you fog this mirror?
Yeah.
Okay,
totally.
you dance at the Cheetah downtown, so that's cool. We'll give you 5 properties and don't worry about it. You've got cash, right?
I remember them talking about it being an introductory rate. And then after 2 years, it would change. So I don't know at that time if I was just naive thinking they had different products and it's just basically a 2-year fixed, if that's all it
Yep.
really was.
Yep.
I don't really understand. I think the amortization story that they're floating out there, and I see a comment about it here, these infinite amortizations. I mean, it makes for a good YouTube thumbnail, I guess. But, to think that that's really happening, are there people getting pushed out? Sure, there's people that bought those crappy products that you mentioned, and they are getting pushed out. But to think that the bank's just going to let people keep their loan at 90-year amortizations or not trigger them to some extent, I think that is, I'm assuming, fairly foolish.
Yeah, no, I agree with you. And just on the infinite amortization thing, it's not really infinite amortization. Those people, they are indeed going to have to renew back to an adjusted amortization, which means if they started with a 25-year mortgage and they're down to 23 years now, and 3 years from now, those mortgages come up for renewal on these variable fixed rate, fixed payment mortgages, the renewal, OSFI's been clear about this, is going to have to be either a complete refinance back to 25 years, which means they have to qualify, or 30 years, or whatever the number is, or if it's the same mortgage, they're going to have to adjust the payments to the proper payment. Now, the reason why this is probably something that's not, it's definitely an issue. It is definitely something that will put certain people in a scenario where they can't renew their mortgage and have to sell. But the reason why at this point we can somewhat tell that it's not a catastrophic issue at this point is because we have all of these variable rate mortgages with adjustable payments that people are still continuing to be able to make the payments on.
Mm-hmm.
So while the people who have those fixed payment variable rate mortgages are going to have a little bit more pain when they come up for renewal, if interest rates are coming down by that point, they may not have that same pain, but there's a good chance that they're going to be able to maintain it. Because what you have to keep in mind is, like, when real estate markets collapse, it's usually because of a large amount of speculators, a large amount of investors, and people who are readily able to walk away from a property walking away. But even when there's a real estate market collapse, like look at the states and look at the states in 2008, the people who still needed to have a roof over their head, most of them didn't walk away from their properties, because if they did, they destroyed their credit. They couldn't buy another one. They were stuck renting. So they just kept making the payments. And for the most part, that's probably what we're going to see when those mortgages come up for renewal. If not, I mean, some sort of help from the regulators or the government to help them stay in their
I
homes.
can see them allowing people to re-am out maybe to 40 years to keep your home. Like, I can see that being a realistic solution, right? I don't like the idea of it, but I can see them saying, you know what, we're not going to qualify anybody new, but if you're in this and you fit this tight box of whatever relief you need, we're going to let you now amortize out. And I don't think that's necessarily going to be a bad thing if you can help people stay in their homes. There is a bigger catastrophe, though, Nolan. 50 people watching and only 14 likes. Like, that is a massive issue. So I will tell you that we have a legitimate, good question. Not that the others haven't been, but this is a legitimate question. Which lenders allow a cosigner not to be on title? Now, I'm going to give you my explanation of this in BC. I don't know if it's different anywhere else. But for the longest time when I was selling real estate, a cosigner could just be a cosigner. A mom and dad could sign. They'll guarantee the mortgage, didn't have to go on title. Then at one point, I want to say 6 or 7 years ago, maybe more, most of the big banks, if not all of the banks, said, we want you to go on as a 1% owner for whichever reason I don't know, to secure the loan better or in some other way. But then a lot of our first-time buyers had to get mom and dad's help and actually have them sign on, which, by the way, when mom and dad look at mortgage paperwork, they haven't done it in 20 or 30 years. They're not very happy to sign a lot of those papers. They don't like a lot of the terms that are there. But is that back? Oh, the likes went up. That is less of a catastrophe. That's good. Is that back? And if so, which lenders allow it?
Well, I mean, Here's a better question. Why wouldn't you want your cosigner to be on title? Or if you're a cosigner, why wouldn't you want to be on title?
I think a lot of parents would just rather sign on the loan than actually have to go on title, particularly here in BC where you've got all these speculation taxes and all this crap that get applied, and you have to now fill out the spec tax form every single year. You got to do all this stuff. You have to sign off on the property when it goes. So I don't know. It was
Yeah.
easier before.
So if you're doing any of those things to avoid any of those things, you're creating a significantly bigger problem if you get caught than not doing it. So typically our experience is people who don't want to be on a title are trying to not be on a title so that they can get approved for other financing and without disclosing. And that by definition is mortgage fraud. I mean, mortgage fraud is an omission or a misrepresentation. Doesn't matter how big, doesn't matter how small. If there's an omission or a misrepresentation on an application, it's mortgage fraud. And the only reason I can think that somebody wouldn't want to be on title is because they're trying to avoid or hide something. And if they're trying to avoid or hide something, that's potentially what they're doing. So, you know, I don't think I've had a client since 2006 who co-signed or guaranteed a mortgage that didn't end up on title, because there's no reason not to.
That's a very political answer that you didn't answer the question. I appreciate that. We saw it here all the time. We saw it here all the time. Parents would just be like for instance, when parents have to sign a gift letter, I've never seen more angry parents in my life where maybe the bank wants to track their funds now. The parents are beside themselves angry about it. It's none of their business where the money's coming from. And it's like, well, no, you're co-signing the loan. It is definitely their business where the money's coming from.
Yeah, well, let's talk about why it's their business where the money's coming from. It's because they're regulated by FINTRAC to determine where the funds are so that there isn't money laundering. And basically, it's the government that's looking at all the funds that go through the banking system going, we want to make sure that this isn't terrorist activity. We want to make sure that this isn't fraud. We want to make sure that there isn't some other form of criminal activity. And no matter what you do, if you're playing around with anything over $10,000 at any time, it's being tracked, period. So going, it's none of their business. Well, it's not really, the bank really doesn't care where the money's coming from. It's the regulators that do. And then it becomes the bank's responsibility to verify.
Here's a good one. I have a fixed 5-year with First National at 5.09. It started just in September. Well, that's actually a fantastic rate. Good job.
Yeah, it's awesome.
Does it make sense for me to switch from a fixed to a variable if the BOC drops 1% in the next 18 months? My immediate answer is probably not, but what does the mortgage man say?
I have to look and see what rates are.
There's no way they're going to be, even if they drop 1%, there's not, our variables are at what, 7% right now, basically?
Yeah, okay. So, yeah, exactly. So if your option was a variable or an adjustable rate at prime -1, we'll just use the previous questioner's rate, you're basically looking at 6.2% as the current rate. So if the Bank of Canada drops by 1%, the variable rate that might be available in theory might be 5.2%, which is still higher than what you have. So the answer would be no.
Yeah, stick with it.
Yep.
I don't know how many more of these we want to keep getting to. Let's keep going. A penalty. Yeah, well, we answered that question, so that's good. Hi, Nolan and Steve. I have 4 rental and 1 principal residence, highly leveraged. Yikes. Ouch. I'm working 3 jobs to survive. I'm okay, still healthy. Hope everything gets better. I agree. The people that are highly leveraged right now, and I am hearing from those people. I am hearing from people that have things going on, particularly, say, projects, development projects and stuff, where this wasn't in the books. And that is becoming a tough thing for them. But maybe you can clarify this, Nolan. A lot of people don't understand that if you own, is it 5 or 6 properties, even if they're all clear, a big bank won't give you any more loans.
Yeah, exactly. there's the occasion where they'll do it on exception, but they don't really want to deal with people that have more than 4 rentals. They want those people to be commercial borrowers, not residential borrowers. I just gotta I gotta say on this, you're working 3 jobs to survive. Like, fucking sell them, dude. Sorry, excuse my language.
No, fair point.
Name's Pan, dude. If you're working 3 jobs, like, you're probably up on them. You probably have some equity. Stop working your 3 jobs. Not all of them. Pick the one that pays you the most, or maybe the 2 that pay the most. If you're working those jobs to keep those properties, they aren't sustainable. Get rid of them. Like, yeah, it's you've got a bad portfolio if you have to work to support your rentals. And just like, if the market turns, you're so leveraged that you're screwed.
And people are holding on to those, right? Like I had another call today. I do a lot of, actually, if you go on the Tom Story show, you can see our interview with a bankruptcy trustee that I've done work with for a long, long time. And what he's seeing right now, it's cool working with a trustee because they're not fiduciaries, so they can share absolutely everything. Except, well, they shouldn't share names and stuff, and they don't, but the stories are all out there. It's fantastic. And he is seeing tons of people that are throwing good money after bad. Tons of people that are getting into I shouldn't say tons. A lot of people he's dealing with are throwing savings and making more money doing side jobs to keep a property of which is going down in value, which they could get out of still with some money, maybe not as much as they had into it. And they're just refusing. They're holding on to that property no matter what. And what people don't realize is when you go to a bankruptcy trustee, if there's equity in the property, your option is sell that property. Like if there's no equity in the property and you can't clear your debts otherwise, you may be able to keep the home if you can still keep paying for it. But you can't magically have $500,000 of equity in your principal residence and then not sell that property to pay off your $300,000 worth of debt you want to go bankrupt on. Like, you have to do it. You have to sell the property. And as these people are waiting and the market's declining here, they're losing what's going to be left over after they pay that off, but they're choosing not to.
Yeah, totally. I mean, if you've got this portfolio and you're like at 50% loan to value on the entire portfolio and it's paying for itself, fine. But if you're in this situation or you're spending money to keep those properties, that is not just money that you can throw away, you got to get out of them. I mean, so here's the thing. I had this realization here in the last couple of weeks. There was this quote. I think it was a Warren Buffett quote. I can't remember. I've talked to a couple people about this story, but basically there's this like level of certainty that if out of university or out of high school, you start saving 10% of your income and you invest in the stock market over 40 to 65 years, you have complete certainty that you will be rich. You not just have enough for retirement, you'll be rich. And now we get to the point where when there's a market like we've seen the last couple of years, every real estate investor comes out and says, oh, you're behind. You should probably do a little bit more and buy some rental properties. And by the way, in order to do that, you're going to get highly leveraged. And they don't explain the fact that borrowing money to invest inherently increases the risk substantially. And it's so important to understand that if you do things right from an early age, you don't need to invest in real estate. You can invest in real estate if you've got enough money put away that the risk of the investing in real estate doesn't create a scenario where you're in a lot of trouble if the market turns. But it shouldn't, if you don't have enough savings to weather a storm, you shouldn't have properties that are leveraged and hope that they're going to be able to take care of themselves. Because if you do, you find yourself potentially in a situation where you have to work a whole bunch of jobs and support those properties. Like, it doesn't make a ton of sense. And then I want to touch on a question here with respect to, so a joint venture income properties.
Yeah, that's
where money
interesting. I was
partners
going to bring that
are
one
on
up.
top. Yeah. Okay, so here's the question. So joint venture income properties where money partners are on title and working partners are not is mortgage fraud. Yeah, if it's not disclosed to a lender, it's mortgage fraud. And the whole problem, this is the whole problem with the real estate investing industry, is that when the market gets hot, everyone goes, oh, just buy houses. It's easy. You can do this. Don't worry about the leverage. Don't worry about having a backup plan of savings. Don't worry about making sure that your loan to value is low and that you've got enough income to support the properties, even if the properties went vacant. It's just like buy, buy, buy. And then we hit a market turn. Oh, and by the way, the thing that causes a market turn to be catastrophic, like in 2008, is when you have a whole bunch of speculators and investors in the market that are treating the market like it's day trading. And that's why the market in the US collapsed in 2008. And also why it didn't collapse in Canada in 2008, because there wasn't that same sort of day trader speculation in the housing market. There was some of it, but there wasn't the same amount. And it's also, by the way, probably why when and if a market turns in Canada, it's not going to be as bad as it was in the United States, is because we've never allowed that same sort of speculating that happened then. But like, this is something that if I could go back and re-educate every real estate investor, we'd talk about reasonable loan to values on complete portfolios and making sure that you're safe and that you have a backup plan and that you're not falling into situations like joint venture partnerships. I've seen this for the last 20 years where people go, oh yeah, you qualify for the mortgage. I'll give you the money. You'll be on title. I won't, but we'll have a joint venture agreement that's not disclosed to the lender. Don't worry. It's after the fact. No, you agreed to give them the money before, and they don't disclose it to the lender. And the people don't realize that they're doing mortgage fraud because they paid somebody who was an expert to tell them how to do it. And that's how they were told to do it. Right. So anyways, soapbox moment over. Maybe.
Well, it is. I mean, I do find it, the speculator stuff is tough, right? Because you need, to be honest, we need speculators. We need people to buy pre-sales. Otherwise, we don't get housing built. It's as simple as that. So you rely on them. Everybody gets angry at them. And then there are people that when the market does good, they make money to a degree. Where I find a big issue is I don't think those people pay income tax to the same amount that they should, right? There's a lot of guys that flip assignment contracts that never pay income tax and don't claim any of it. And if the CRA finds them, they're going to be smashed. And the CRA finds them occasionally, not always. But that sort of thing of the flipping the paper is nothing I want to get involved with. And I mean, we do assignments rarely. I want to say I've done, averaging 80, 85 transactions a year. If I've done 5 assignments in my career, that's a lot. And I just don't see the problem with the assignment is it's never a savvy investor that's trying to do that.
No,
never, not once ever.
Because a savvy investor wants income, right? They aren't going to make an investment where they don't have some income coming in from that investment.
I mean, if they want a cash flow positive, maybe not. I think that's probably because you come from a market where cash flow is more prevalent. I mean, there is a thought, like in stocks, right? There are dividend stocks and then there are growth stocks. And that might be the difference between like a Calgary market and a Vancouver market. One is a growth stock and one is, or up until recently, I hear you guys aren't even cash flowing anymore.
I haven't looked in a while.
Yeah. Well, we had Andrew Russell on the podcast in Red Deer, and he was like, yeah, nothing cash flows here. Nothing. I was like, oh, okay, that's interesting. But
my properties I bought 5 years ago, cash flow for sure.
I'm very interested to see when my 1.89% comes up, what situation I'm going to be in at that point, because the down payment is all paid off because I borrowed that too. So that's all paid off. And I'm really interested to see what the numbers look like when I renew in 26, February of 26. I'm very interested to see how the rental increases will affect. I think I'm probably going to be break even to minus $100 a month.
Yeah. It depends where rental rates go too, right?
Well, so far the tenant's staying. I hope she stays, and it's been fantastic. Treating the property really well, which is great.
Oh yeah, you guys have rent controls. I always forget about that.
Oh yeah, we have rent controls, man. 3.5% next year is the top. Even though they said they would. So here's something sneaky that the BC government did. They have a bulletin that they put out in February of this year, and I saved the web address, because it was just a PDF. You know, the government puts out stupid PDFs instead of on websites or whatever. So I saved the PDF as the web address. I didn't actually save the PDF, which is what I should have done. And it said, Next year, after this, last year was 2%. Next year, we're going to go back to inflation. We are for sure going to go back to inflation. And then September comes around when they announce and they're like, yeah, inflation's still too high. We're not going back. So I went back to that website. They replaced it with the new bulletin. So the exact same web address, new PDF.
Yeah.
Right. So you can't actually track what the old information was. It was a really sneaky little thing.
Yeah. So as a YouTuber, you got to keep all those documents going forward. So
I
you
am
can,
going
take a look at them.
I'm going to definitely save those next time around.
You know, and that's so like that whole rent control thing is so tough because like there's one thing economists agree on and politicians don't. But every economist out there, with the exception of like a very, very small group, all agree on the fact that rent controls have a negative effect on the lowest income people. And the reason why is because if you have properties that have rent controls, the landlords then become incentivized to find ways to get those people to leave. And whether it's kicking them out on the most simple missed payment, whether it's saying, well, I have a family member or I'm personally going to live in there, so you need to go, whether it's, you know, claiming that it needs a renovation. I mean, in New York, there's landlords that report themselves for mold and health issues so that the tenants have to leave because they know that it's going to make them more money if they spend the money to remediate things. Because when they remediate it and renovate it, they can then rent it for more. Like, it's bad, and people just don't realize that.
And the other side of that is so one thing they're talking about doing here is if that tenant leaves, the rent stays the same. I don't know how they would ever enforce that.
Yeah.
But if they do that, the opposite side of a rent eviction is live in squalor. Right? So careful what you wish for, too, because you can't complain about the guy not doing any renovations and fixing stuff up if he doesn't have the ability to do any renovations and fix stuff up. And then what do? Exactly. They sell. So right now we're seeing a lot of investors that bought in 2021, probably on variable rates, that are all cashing out. Like, a lot of the sales that are happening right now have only been held for 2 years, those properties.
Yeah, there's a lot of potential chaos, and government dipping their hands and toes into everything doesn't help the chaos. In fact, it probably does more harm than good.
Here's one. Sold my house in the Lower Mainland, November of 2022. So Lower Mainland, November of 2022, big variety there. If you're in Vancouver, the market never really dipped. If you're in Chilliwack, congratulations, you sold at the bottom of the market. Out of the market, watching it slowly shift to a buyer's market. It's actually gone from a buyer's market when you sold, if you sold in November 2022, into a crazy seller's market again, and then now back into a buyer's market in detached. But that's more on my side of the water, the Fraser Valley side of the river, rather than the Vancouver side. The Vancouver board's actually still doing fairly well. Better to buy now or wait for more potential pressure in Q1. Personally, I only see prices going down. So if you indeed are a cash buyer right now, December, January, February is probably going to look like a fantastic time to buy. It's probably going to look like a really smart time to buy eventually. I just don't think I'm actually doing a video for my channel right now, which talks about that. Like, do you think we're going to end up at a spot at all where payments come down to be reasonable again?
Yeah, I do. I mean, there's more than just the payment variable to that question, and there's the wage variable. There's the home value variable. There's a whole bunch of variables at play, and what happens in a market is eventually it comes back to the mean, and it will eventually come back to the mean in some way, shape, or form. It's just a question of which of those variables is going to be the one that brings it back to affordable. Is it going to be the housing prices? Is it going to be that wages catch up to everything else and inflation catches up to everything else, making it essentially the same level of affordability from the perspective of the amount of dollars of tomorrow's dollars that are actually paying for it? You know, it's which variable matters. And or which variable will change. And I don't know which one it'll be, but yeah, they'll be affordable again. Um, the big thing is not trying to time market, right? It's, I think that's the thing that in the real estate world right now, everyone needs to take out of their thought process is what's going to happen tomorrow, because we can't predict that. It's what's the situation am I in today, and what does my future look like if I don't make this decision to buy, or if I make the decision to rent instead, right?
Well, I think there's a whole bunch of people that are going, okay, $2,600 a month I can buy and I can stomach that, but now it's $3,600 a month. I don't think it's
Yep.
coming back down to $2,600 a month. So your
Yep.
options then are, because if it comes down in price, it's because rates go up and the qualification always remains the same because your GDS is going to be 39 whatever percent. So what you're alluding to there is then to get that back into affordability, the wages have to go up. I don't think that
Yep.
we're just magically going to go back to everybody paying $1,900 a month mortgages,
No,
right? That's
not
gone.
likely.
That's gone. So how do we get back to affordability? Sure, prices can come down, but that doesn't mean your payment's going to change. Wages have to go up. I think we're going to see massive wage inflation over the next bit, which actually could be not necessarily the best thing ever for inflation.
And it's been a long haul where wages haven't kept up with home values, rent or ownership values or costs, and that largely has to do with the transition from single family income or single income families to dual income families, and then the question becomes when does the dual income family scenario start to hit the limits of affordability, and when we hit those limits, either we're going to go to triple income families or we're going to find things start to level out. And here's my big concern. My big concern is the people that got the 2020, like mid 2020, late 2020 mortgages are going to be the first ones that have to renew into higher rates. And if rates don't come down before them, those people are going to feel a ton of pain.
Yeah.
And it's going to be their pain that causes, if they feel that pain, that causes rates to come down. And then it's going to be like the 2021, 2022 buyers that end up with slightly lower interest rates because they just happen to be in the right timing in the cycle. But if I'm like that 2020 buyer and I've got any kind of mortgage that's not adjustable rate and I haven't already felt the pain, I'd be doing everything I can to prepare for what could come and hope that it doesn't.
Yeah. And because in beginning of 2021, so this is going to be the 26 renewals. That was the really, really low point, right? Like the 1.49% 5-year fixed.
Yeah.
Because right when the old pandy hit, it was still a fair bit higher, right? So then we have the 2021 people are who I'm worried about. So let's say you bought January, February, or completed January, February of 21 at 1.49%. And since then, you've put your head in the sand. And you're making your $2,700 a month payments. And you were qualified. Now, remember, the stress test was smaller then. It was 475. So those people could be in trouble. But I'm reaching out to those clients of mine. And I'm saying, listen, you need to take a look. And a lot of them are ignoring me. A lot of them. But you need to take a look at what your payment would look like at 6.5, because what you should probably do right now is you can afford 100% right now. You can afford 4.75% because that's where you were stress tested at.
Yep. Totally.
So you should increase your payment as if it's 4.75. And then when if you can increase your payment, which I found out my mortgage, I can't do that. So I have to lump sum only.
What?
Yeah. Can you believe it? Manulife, you bastards.
I didn't know that.
Yeah, well,
Interesting.
I found it out. I wanted to increase my payments. They wouldn't let me. But increase to 475 now, and then you've still got now, what are we, 23? So you're going to renew in 26. So you've got a couple of years anyway, 2.5 years maybe, of not being you're going to be hurting, but you're going to hammer down your mortgage. You're going to hammer down your principal like crazy, and then I'm hoping at that time, maybe we can get to a 5.5% rate. Your payment still goes up again, should you choose to keep that, or you re-amortize out and get it back down to your now comfortable amount. Right?
Can I make a suggestion on a little tweak to that I would do? I would, instead of increasing your payment, I would be taking that money and I would be putting it into some sort of money market fund or some sort of bond that lines up with your renewal date. And the reason why is
Yeah.
because I genuinely believe it's better to have cash on hand than it is to be paying down your mortgage faster, especially in times like this. So if somebody doesn't have cash on hand, but they want to prepare, don't increase your payments, put the money aside, make sure it's in some vehicle that's getting at least the interest rate that you would be paying right now, and just have it accumulate until you get to that point.
Is
And
the
this is
compounding
especially,
mortgage pay down not a benefit though, you think, right now?
well, money always grows faster than it saves. So if you have a loan that has a 5% interest rate and you have a investment that has a 5% interest rate, you'll actually make more money at 5% than you'll save by paying off the debt. Now, if you do this in a TFSA, it's completely tax free, so everything's equal. The only time where it might be beneficial to pay the debt down is if you didn't have tax free savings available, in which case there's a tax implication on the growth, and that throws the numbers off. But
But
if
nobody's
you can
saving
say
more than that 80 grand or whatever's in your TFSA right now.
no,
But I guess we should then stress that has to be a guaranteed investment. That has to be, I mean, you're not going to buy in bank stock with that right now because your bank stock could half.
Yeah.
Right. So that
Yeah.
has to be a GIC or a bond or something, and it has to line up for when your renewal comes.
Yeah. And probably want to get some professional advice on that, because, for example, if you buy a 2-year bond right now, you want to make sure it's a 2-year bond and not a 5-year bond you're buying on the open market, because you want it to come up for renewal, for lack of a better word, on that date, so that you're getting all of your funds back.
This
Because
is
otherwise,
this is not financial advice. I guess we should put that in there.
I guess not. But anyways, my big thing is cash on hand. If you want to be prepared for, let's say you think that there's going to be a depression and it's going to be really bad, my big advice would be get yourself a year's worth of food that you can store in your basement. Make sure you've got 3 to 6 months worth of your mortgage payments saved up. And then if you lose your job and you don't have any money, at least you got food to eat and a roof over your head. Forget the emergency fund of 3 to 6 months. Get the food in your basement, arm yourself, get your stuff that you need in case everything, if you really think it's going to be that bad, people cheering for the crash of civilization, it's hey, you're
also
probably
you better
the first one
you better learn how to melt down your gold too, right?
Yeah, exactly.
My wife still laughs at me because right when lockdown was happening, I went to the store and I just bought, I don't know, a case of canned tuna. I'm like, we might need some protein here over the next few weeks. We tossed that crap out 2 years later. She's like, can we get rid of this now? I'm like, yeah, food bank. There we go.
Yeah.
Get it out of here. There was another good one here. Do lenders typically confirm that the property is insured prior to funding the mortgage? So let's say, I know it's required in the terms of your mortgage to insure the property. Do they check when the mortgage funds that the insurance is actually in place? I think I know the answer, but let me know.
Yeah, lawyers instructed to verify it.
Yeah, so the lawyer, as far as I understand, need the insurance binder to fund.
Yeah.
I had a deal almost not closed that way because the client unfortunately forgot. Right? So we're on the closing day and it's like, okay, can you give me your insurance binder? Yeah. What was it?
And why wouldn't you fire insure your house? Do you really trust your neighbors not to burn down your house? Because, by the way, the primary reason that somebody's house burns down is because their neighbors burns down.
Yeah.
Right?
Well, yeah.
Or
not your neighbor burns down your house. Not your neighbor burns down your house, but the neighbor's house burns down. It jumps and catches yours.
Exactly.
Yeah.
And you got to be both certain that you are not the idiot that's going to burn down your house and that your neighbors are not the idiots that are going to burn down your house. And you might want to go 2 or 3 doors down in each direction and just confirm that they don't light candles as well.
I hear in Toronto, they're going through a bunch of that right now. Bunch of development sites that are, my mom used to work at the fire hall,
Mhm.
and they had a term for that. Firefighters had a term for someone trying to collect insurance money, and it was financial combustion.
Yeah.
Right.
There's a show called The Bear right now that specifically deals in that and how you aren't allowed to say that. It's a restaurant show on Paramount, maybe. Yeah, it's pretty good. But yeah, I know what term you're referring to.
There is actually a comment here about your tri-income families, with a little bit of joking behind it. But trust me, it's here. It's more than here. We have many, many people in my market who live in multi-generational households where you have 4, 6 people paying the mortgages. And trust me, that's a very fast way to pay off your house. And as soon as that house is paid off, guess who's buying the next property together?
Yep.
Right? Like, it's a very good way if you can. The problem is I don't like my family enough to live with them and invest and just buy up real estate that much. But there are people who do live that way, and they crush it financially. I don't know how they do
Totally.
it. I don't know how they do it mentally, mind you. I don't know if
I also think they need to reduce the societally acceptable age for work to like 8 years old.
They what now? Say that again?
They need to just lower the societally acceptable like age to work to like 8 years old. So instead of it being like you can't get a job till you're 14 and 12 is child labor, like if you're 8, go get a job.
Do you
That's what they
know
need to
how
do.
many? Yeah, you're joking. I know that's hilarious, but do you know how many people when I said that, you don't see any more 14-year-olds working at McDonald's or anything, how many people got mad at me for that? And like, that's child labor. No, that's the right age. 14 is the right age to get a part-time job. And that is now lost. And now we don't even have people in university getting part-time jobs to help pay for the university, even though university is like $1 billion now to go through.
Oh, kids need to get jobs.
Kids need to get jobs. 100% kids need to get jobs. And a lot of kids, I get sick of hearing friends, clients. My old employer used to say this. He's like, they'll have enough time to be an adult when they're an adult. I'm going to let them until they're out of college just have fun. I'm like, that is you are setting your kids up for failure.
Yeah. Let's not teach them the right habits and hope that they find them on their own at 25.
You know what really is even worse than that? 80 viewers and only 28 clicks of the like button currently right now. So that stinks. Will lenders be leveraging that most renewal clients can't shop around on renewal? Do you think lenders are going to rake their own clients over the coals?
I think they will. I think a lender will
nice.
do whatever they can to be profitable, especially the big banks. But I also think that when and if they start doing that, the other lenders will go, there's an opportunity to be here, the knight in shining armor, and you'll get competition for those clients. And, the people who haven't made all their payments, the people who have derogatory credit, anybody who in general is just like a jerk on the phone, to whoever they're talking to at the bank might find themselves in a situation where they have to pay more. But I think there's going to be an opportunity to move to other lenders. The real tough question is like, if we lose a ton of property value and those mortgages don't make sense for a lender to take on, that's going to be the real question.
I wonder how that's going to go. So here's the crazy part right now. Like, we saw in my market a 25 to 30, in some markets like Mission, BC, was like a 40% decrease in detached home prices last year.
Wow.
So it was there. And then it went back up a little bit. Now it's come off a little bit. That is the part of me that goes, okay, well, we've already kind of deleveraged a little bit. Right? Like, the new people qualifying right now, I guess we should be clear about that. The new people qualifying right now at 6.5%, buying a place for $600,000, you don't got to worry about them.
They can afford it.
They can afford it. And a lot of them are buying from the people that can't afford it. So that might actually be, and that's what makes me think that the government or whatever bodies, banks or whoever, will try and stretch this out as long as possible to replenish those people naturally or unnaturally, I guess, as opposed to making the whole thing crash. They want to keep it going because it will reduce the amount of pain in the future.
Yeah, totally.
As we bring more people that can afford it. And here's the biggest thing that I'm noticing right now is the Canadians are like, yes, stuff is unaffordable. And I mean, that's always the complaint. Everything's always, I've never seen a time where they were like, oh, how's this seem cheap? Right? Like that's never happened. But the talent that is immigrating here is making so much more money than anybody I grew up with. So much more. The clients that I have met specifically off of YouTube, and the reason I meet a lot of clients off of YouTube is they're coming from overseas. They don't know anybody here yet. So they're like, oh, this dummy looks like he knows what he's talking about a little bit. Maybe I'll reach out to him. We help them. And their incomes are insane. Their incomes are at least double what I would consider to be somebody that I grew up with here in my market. You know, I don't know if it's a whatever, plumber, mechanic, whoever else, but they're all IT guys. They have great incomes. We're talking like $120,000 to $175,000 each, and there's 2 of them in a household.
Yeah, totally.
It's not uncommon.
No, and that's what's really interesting is they're really good at getting paid what they're worth. Like in society, for somebody who grew up in Canada or the US, you get a job, and it's just recently that millennials start moving around from job to job more frequently. But like in the past, you just got a job and you stayed there for 40 years.
Yeah.
And you never really asked for what you were worth. You never really shopped around and your employer knew you weren't leaving. So they just pay you whatever they felt like paying you. Now we're in a place where everyone shops their jobs all the time, especially people who are new to Canada. They know what they're worth. They know what they're worth in the open market, and they get paid what they're worth as a result. They've got a different ideology around it, right? And it's brilliant. It's smarter.
And it's just everybody's going towards those jobs right now from what I'm seeing, but not everybody that grew up here is going towards those jobs.
Yeah, that's true.
Right? I'm not seeing any of that. Well, that's not true. I do have some friends that are in the IT space and they do very well. But the majority of that talent is coming from overseas, and we're kind of getting left in the dust, right? And that I think is a result of like my parent or my grandfather at one point came over here after the war from Europe, and he had drive to get stuff done. And probably as we sit here, most people have a little less drive, and it's the new people looking for a new start and that probably have a little bit more drive than the people that are here.
Yeah.
I think that's
and the good news
some
is that
victimhood that we're going to have for sure.
Yeah. And that breeds competition too, which is a good thing because it won't always be like that. People will want to do better and get better jobs and realize that they have to compete for the best jobs if they want to be able to afford the life that they want to live, right?
It's tough though now because I think this is actually here's my actual opinion on the whole thing. This is actually a very good thing for the rest of the country. It's going to be very tough for Vancouver and the Lower Mainland. It's going to be very tough for Toronto. The rest of the country is going to start to flourish as a result of it.
Yep.
And I think that's a great thing. I even saw some stories in the news about somebody in Calgary not being able to pay their rent, right? And or even their mortgage, I guess. And my thought is like, how can you not do that? But
no, there was one guy. We know all about him. It's just one though. Just one dude.
Just one guy.
Just one guy.
He made the news. They're like, we better cover this story.
They found the guy. It was just him. Here's the thing. Like, if you don't believe from a world stage perspective in Canada, if you don't believe that we have the resources that we need, if you don't believe that we have the talent that we need, if you don't believe that this is one of the best countries in the world to live in, regardless of all the little annoying things, like I think you got to pack it up and go somewhere else. But the question is like, where are you going to go? And the response is there's nowhere else to go. This is the best somebody's going to get it. And yeah, there's going to be cycles in government where you aren't happy with the current government, and then it'll flip over to the other one. Then we won't be happy with that government. And we're at the top of a cycle in a whole bunch of places right now. But 5 years, 10 years down the road, are we going to be upset that we live in Canada? And the answer is absolutely not. Like, it's If you don't think that this is the best place in the world to live, you're out of your freaking mind, regardless of what
Yeah.
home prices are, regardless of your politics, regardless of everything else.
I couldn't possibly agree more.
I want to
Point
hit
where heart
that
breaks.
question about what is the probability small banks get bought or out or merge with big banks. We saw this with HSBC. Foreign banks tend to leave the market when things aren't going well, where they originated, and they do well here. So they sell off the well-performing asset. That's what's happening with HSBC. It's what happened with ING Direct. So you might see some of that. But if you're talking about like the lenders like First National, CMLS, MCAP, keep in mind that those lenders all typically use funding from big banks or big American banks. So they aren't really holding significant books of businesses. They're servicing them. So the chances of those companies getting sold off are slim unless there's something that happens that reduces the profitability of servicing the mortgages.
Because they're more of a customer, or they're almost like a commission sales team.
Yep, exactly.
Right?
That's
They're not actually competition. They're helping the banks just through
yep.
the back end commercial end of it.
Yeah. So what they're doing is they're selling the mortgages from the securities, or they're selling mortgages to the security side of the business. And what happens is like RBC will have a limit on how many mortgages they can do. So they'll hit those limits, and all the banks hit their limits pretty much every year on how much mortgages they can do. That's why you see often rates go up in the fall.
Yeah.
Is because like Scotiabank will hit the limit of how much they can lend. So it's like, oh, we went from 4% to 6% for no reason. Well, it's actually because they can't lend anymore. So what they'll do is on their securities side, they'll start funding other lenders, and they'll build out a book of mortgage-backed securities, basically, or other types of mortgage-related securities, in order to continue to have a place where they can get a return on those investments.
Yeah. Yeah. A lot of people
Right.
don't understand that like right now, this time of the year is the worst time to renew a mortgage every single year. Usually
Yep.
it's November. You got the fiscal year end for the banks. They can't lend any more money. They go, well, if we are going to lend it, we're going to lend it at a premium.
Yeah. It's
And
the exact opposite of buying a car. The best time to buy a car is at the dealership's year end at the end of the month,
Mhm.
right? Because they're trying to hit a target to get a bonus from the manufacturer. That's the best time to buy a car, usually in the fall. But with a mortgage, it's the complete opposite. You want to be getting your mortgage when they are competitive. Although the problem with that is the original mortgage you get to buy the house, if you get it when the rates are competitive, it's also usually the busy buying season, which
yeah.
means you're probably paying more.
Yeah.
So
I wonder if we're going to get to a spot where we do go back to more of a normal market where the spring is the best time to sell and the worst time to buy. But it almost feels like that. It feels like we've gone now. Last year was maybe an anomaly as well, but this year, for sure, the spring market was crazy. And since then, it's been super quiet. It's picked up now, actually. Our October is probably going to be an above average October, which is nice to hear. But I do think there's a chance that we do get back to, yeah, the spring is the right time to sell. The only problem is you also got that buy side if you're trying to upgrade, right? If you're not just
yeah,
leaving.
totally.
I think we should. Are you good to stick around, or you want to wrap this up? We're an
Yeah,
hour and
stick around a little bit
15
longer.
in.
Let's give them another 5 or 10 minutes. If you got any good questions, we'll do 5 to 10 minutes question and answer period, or we'll just shoot the whatever. I'm not going to touch. You know what? I'm not going to touch the world conflict.
World conflicts are not
here.
good for anybody.
Yeah, there's just too much bad stuff going on in the Israel Hamas situation, Gaza situation, to try to determine what it's going to do to finances. I just think that's a scary situation right now on both sides.
Yep.
Yeah.
Who knows if that's gonna what would affect things here differently at this point? Okay, let's go this way. I was very much of the mindset that they need to increase rates one more time. Doesn't look like they're going to.
Yeah, I mean, it's so tough, right? Because the battle they were fighting was inflation. the battle they're fighting now is unemployment. And it's like they're tipping the unemployment scales. I mean, Scotiabank announced they're laying off, was it 1% or 3% of their employees? RBC's already laid off a bunch. So you got the biggest organizations in Canada, the banks, laying off people. That's going to trickle down. And then now I think the Bank of Canada needs to be concerned about not tipping that unemployment scale too far. Because if they do, that that that'll determine how significant of the recession will have. And it could be soft, it could be hard, it could be devastating. And that employment number, and the one thing I want to talk about there is people always look at employment numbers, then they look at unemployment numbers, and they don't realize that they're different numbers. The unemployment is the number where people are trying. That's the people who want to work, not having a job. Employment is the percentage of people who are working. And those two numbers can correlate, but they can also not correlate. But the big thing is when you start getting a lot of layoffs and a freeze on hiring, when those two things work in combination, that has devastating effects on the economy. And yeah, it'll bring inflation down really fast because people won't have any money to spend on anything. And that's what I've been talking about the last year or two is, be careful what you wish for. If you're hoping for the real estate market to crash, what you're really hoping for is that there's lots of unemployment. And if you're one of those people who is hoping for that thing, there's also a really good chance that you're going to end up on the bad side of that equation. Because what people don't realize is like you get to 8 or 9% unemployment for a year. Well, typically people end up not working for about 3 months, which means it's not 7 or 8% of people that end up unemployed. It's like there's 4 cycles of that in a 12-month period. And you end up with, almost a third of people who at some point end up without a job and have to deal with that pain for some period of time. So, a recession and a real estate collapse is not something anybody wants.
Unless you are in the YouTube comments, then for sure you want that. Because somehow you
Yeah.
think you're going to come out unscathed, right? Which is a ridiculous situation or
Totally.
thought that's going to be. Does it seem like detached got hit harder than townhomes and condos? Absolutely, in my market, detached is the worst market right now. We're firmly in a buyer's market across the entire Fraser Valley. Townhomes are still in a seller's market, believe it or not, even though the prices have come off. Townhomes are where all the families are going. Condos are doing not bad, or they're starting to come off as well. So we are seeing a big drop in prices, and it has to do with that, what we started off this video with, which was just the fact that you've seen about a 10 to 15% downward pressure on affordability, so prices need to adjust. That is for sure going to be the case over the next little bit. The question is how long, right? How long does that go? I didn't see at the beginning of this year when I put out my prediction video, it was like, we're going to see another 5% slide for the rest of the year. And then we shot up 15%. So shows you what the hell I know, right? And that could happen again next year. We have no idea.
Nope.
They pause, and it could be back off to the races again, right?
Yeah. And that's really what we're at a pause in the market right now. And it's just everyone waiting to see what happens next. And I think it's just as likely that we get positive news from a real estate perspective as it is we get negative news, and that just keeps going up, or maybe it comes down slightly.
Is it better to put down 20% and have a higher interest rate, or pay less and pay the mortgage insurance, or put down less and pay the mortgage insurance?
It's easy. It's just a math equation. What's the difference in the interest rate over the 5-year period? And then is that bigger or smaller than the insurance premium? Very rarely does it make sense if you're putting 20% down to pay the insurance premium. But it does on occasion happen.
Let me realtor that up for you. If you are a first-time buyer, get in as soon as you can. And that is usually the people that are told by their parents, hey, you have to save up for 20% down. Those people often save for 10 years and house prices double and they never get their 20% down. So get in at 5% down if you can. And when the time is right for you and all that stuff, and if you plan to own it for 5 years or more and all that wonderful disclaimers that we normally do. But I do not mind CMHC insurance at all for first-time buyers, as long as they're not making a stupid decision and trying to think they're only going to live somewhere for 6 months.
Yeah, and like from a practicality standpoint, if somebody's scraping to get 20% and then is going to have no cash available, I'd rather see them put 15% down and hold 5% back in cash so that they have cash reserves in case they need it at some point.
Do
What
credit
does it make?
unions also auto renew mortgages at the end of the mortgage? Is it like a bank without requalifying?
I mean, no lender has to auto renew, and we're going to see some not auto renewing. Scotiabank had somebody in an article say that they were going to do customer deselection. So historically, if you had a mortgage with pretty much any lender that wasn't a private lender, so any A type lender, which would include credit unions, they would auto renew as long as you made all the payments. Um, could that change? Potentially. I mean, there is a possibility that if the market collapsed and values were way less than what the outstanding mortgages are, that the banks might decide that they don't want to have those mortgages on their books. But there's also like a whole bunch of other factors that would encourage them to continue to keep them on the books if people were making their payments. So yeah, if you've got a mortgage with a credit union and you've made your payments, at least at this point, it looks like you'll probably be auto renewed without too much issue.
Hmm. Well, credit unions seem to be the best deal out this way for the last 6 months or so.
Yeah, makes sense.
Do you think, Nolan, this is for you, do you think Alberta real estate will become like BC, continuous growth in a 10-year horizon, or Alberta still cyclical?
Yeah, I mean that's a hard question to answer. I think Ontario and BC's markets after 2006 got detached from the rest of Canada for whatever reason. And those two markets probably for different reasons. Uh, could Alberta find themselves in the same sort of situation? So like keep in mind in 2006, Calgary and Toronto real estate prices were identical, pretty much. Like average home price was whatever it was, 350 or 460,000. I can't remember what the number was. And then all of a sudden Toronto detached from the market. And could Calgary be the next city that kind of detaches from the rest of the Canadian market? Yeah, it could. But who knows? And yes, very much so. Alberta continues, any resource rich economy will continue to be a cyclical market. It doesn't matter if it's Alberta or if it's, you know, China or if it's whatever other resource rich economy you want to look at. When things are good, they're good. And when things aren't, they aren't. If Calgary diversifies and ends up being less resource rich and less resource dependent, which is happening, then yeah, it could very much be a market that comes up quite substantially.
Yeah, I think they should diversify and become more resource dependent. It'd be great. Do both. Do it all. There's no reason
Yeah.
that Edmonton shouldn't be, well, let's not call Edmonton. Calgary shouldn't be the Dubai of the North, right? Should be happening for sure. But
Yeah, I mean, I still think that aside from the fact that there isn't an ocean right there, which I think Vancouver has going for it, I think Calgary is the best place in Canada to live.
I've never lived anywhere else, so I don't know. Maybe
Well,
what?
me either, but you know, livability for sure. From an affordability versus livability standpoint, it's pretty high up there. I mean, I think I don't think there's a lot of cities that you get the best combination of both. I mean, there's an argument to be made for Pittsburgh. There's an argument to be made for Atlanta. There's one other city in the U.S. where there's an argument to be made for livability / affordability metrics. But for the most part, like Calgary's a pretty awesome place to live.
Yeah.
And it's cheaper than everywhere else.
All right, man. I think we should wrap it up.
Yeah. No, I enjoyed that. Thank you.
Thanks for doing this live. I'm sure, hopefully, we'll see it maybe reposted on your channel later on. More comments down below. I'll try and get back on the replay if you've listened this far. I probably should have said this earlier. But if you got more questions, type them down. I'll try and get back to them without too snarky of replies. Those are only saved for the people that deserve them. Thanks for doing this, man. I appreciate it. Hopefully we'll see you again soon on the Tom Story Show, of which I should probably also link in the description of this, but I haven't done that yet. So
Yeah,
hopefully we can get that doing. Thanks for doing this. And yeah, any last final words of wisdom?
No.
Did we answer?
Man.
Was it fixed or variable? Which one is it?
It is Pay more attention to the product and everything else before you make the decision on fixed versus variable. There's
Awesome.
1,000 things to consider. Here, get this. Get this book.
Look at mine. Hang on.
Yeah, I noticed it's right behind there. And read the chapters on product and penalty, and this will tell you everything you need to know about the more important factors than the price. And then it's also got the chapter that's based on the Mosh-Malevsky study that talks about variable versus fixed and how to determine between the two, but focus on the lender and the product before you start making decisions.
I only put super special stuff back here. You know that, right?
I know, and only when super special people are on the show. It's probably not there most of the time.
No, it's back there now permanently. It's back there. I've also got a Tom Story Show sticker.
Oh,
I've also got
one of those too.
This right here. I don't know if you can read it, but it's actually Surreyopoly.
Oh,
so it's a Monopoly game for the city of Surrey. Shout out Randy Mann for hooking me up with one of those. There's some BC Lions back there. Neil deGrasse Tyson's back there.
When's the cat doing another video?
The cat did not get a good response for doing the video, so
maybe the cat picked a bad topic. Let him talk again.
I don't think the cat. Nobody's interested in the cat. They're interested in doom and gloom, and more of those videos are coming soon. So. All right, awesome, man. I'm going to hit end on this. Let me make sure this turns off before we start swearing and saying all the bad stuff.